All right, so what I want to do in this class, it's my goal to teach you the numbers side of business. So first thing you need to know, financial statements. Financial statements are based or built on the accounting equation, and you may have seen this before. If you have, great, that's got you that much ahead. So we start with the accounting equation. Has anybody ever seen this before? What are assets for a company? Remember the little PowerPoint that I showed you last week? We met, and I recorded that. So if you missed that session, I did record that, so you can go back and watch that. So I took us through a little fake company that I created, and talked about how the equations or the transactions affect the accounting equation. So if you did not get to attend that, you might want to go back and look at that. And I talked about the accounting equation. So I want to hit that again. Because this time I can have a pen in my hand. I feel like I'm teaching if I have a pen in my hand. Okay, so basic accounting equation: assets equals liabilities plus owner's equity. Assets to a business is everything that the company owns that has future economic value. Does that make sense? Everything that the company owns that has future economic value. And of course, you can't make money without assets, right? So as an accountant, I need computers and office furniture and supplies, money, right? You always have to have money to pay the utility bills, to pay your suppliers, to pay your help. Okay, so obviously you have to have money no matter what you're going to do, right? So if I'm going to do a factory, if I'm going to manufacture stuff, then I'm going to have lots of equipment. I'm either going to have to buy or rent a building. I'm going to have to buy raw materials so that I can manufacture, right? So all those are things that a company owns that's required in order for it to be able to carry out its business function. Does that make sense? So assets. All right, so examples: land. That's something that a company can own that has future economic value. What's future economic value? I can buy and sell in the economy. Is land buyable and sellable in the economy? Absolutely. Absolutely. It's a great asset to own, right? Because they don't make any more of it. Anytime you have a finite amount of an asset, then the value is only going to go up, right? Because as you have more and more people demanding that asset. Did you listen in econ class when they talked about supply and demand? If you have low supply, high demand, what happens to price? Okay, so that's why real estate is a good investment. I got several pieces of it myself. Okay, so land is an asset that a company can own that has future economic value. Buildings, right? Buildings. Equipment, so all those computers that's over there in my office. If I'm a manufacturer, then all the equipment that I have in my factory, okay? What about the raw materials that we talked about? That's an asset that has future economic value, right? Especially after I turn it into finished product. But even as raw materials, it has future economic value. We call that inventory. Inventory is everything that the company owns that is available for sale. Of course, unfinished inventory is not really available for sale yet, but it's a step toward that. So therefore, we still call that raw materials inventory. Okay, what about when somebody owes me money? Is that an asset? Yes, that's an asset. Does anybody know what it's called? Accounts receivable. Does that make sense? Accounts receivable. What if I owe somebody else money? Accounts payable. Good. Okay, does that make sense? So accounts receivable, that's when customers owe me money. I've done a job for somebody and they haven't paid me yet. Okay, accounts receivable. Listen, well, we didn't say cash, right? Cash is certainly an asset that a company owns that has future economic value. Good. All right. So we have to have stuff in order to make money. Assets. Two ways to finance it. We can borrow it, or we can get that money from stockholders, owners. We can share the ownership of the company with other people so we can solicit other owners. So some of the money comes from borrowing and some comes out of the pocket. I usually get my pocket out when I say that, of the owners. All right. So when I started my business 32 years ago, I saved up some money. Didn't want anybody to be the boss with me. I wanted to be the boss. I wanted to be one what told everybody else what to do. Okay, so I saved up some money, didn't have to borrow anything. Of course, I'm an accountant. You know, whenever you start a service business, your capital investment's low. Okay, I gotta have some furniture and some equipment, some money, but I don't have a large capital outlay. So when I started my business, I didn't need that much money to start. Okay, makes sense. So I didn't have to borrow money, and I didn't have to solicit other owners. But sometimes you do, depending on what you want to do, how much money you need, right? Okay, so liabilities are everything that the company owes to outsiders. So assets is everything that the company owns. Liabilities is everything we owe to outsiders. So therefore, owner's equity is everything that we owe to insiders, right? Owners. Okay, does that make sense? So all the assets are financed with money from other people or from the owners. Good. So let's talk about some examples of liabilities. The most used is accounts payable. So every month I'm buying supplies from vendors. I'm incurring a utility bill. I am buying services from other professionals. Those are all accounts payable. Anytime I'm buying something from a vendor that is supplying me either a good or a service that I'm using in my business, that's accounts payable. They did something for me, provided something for me, and I owe them that money. Okay, accounts payable. If I borrow money at the bank and they make me sign a note, so instead of calling that accounts payable, we call it notes payable. So the difference between the two, notes payable is usually long-term. It's a legal document, and it usually includes interest, okay? Because when I borrow money from the bank, that's how they make their money, is they charge me interest on that money. Does that make sense? So notes payable. So if I'm borrowing from the bank. And then, of course, if I'm really big and I can afford to do a bond issue, I can get lots and lots of money, millions of dollars, by issuing bonds, corporate bonds. And those are called bonds payable. It's very expensive to do, so you don't want to do it for small amounts of money. You want to do that for large amounts of money. Does that make sense? And then, of course, when we owe our employees, maybe we haven't paid the employees everything that we owed them for the month. We're going to pay payroll maybe as the beginning of the next month, so we may have wages payable because we haven't written out the payroll yet. We may have, taxes payable? What else? Any other payable that you can think of. But if a customer pays me in advance, and sometimes I get paid in advance. Sometimes I have people that need an accountant, and they come and they offer me a stipend to start the project, so they pay me in advance. So that's called unearned revenue. So notice that's the only one that doesn't say payable. But unearned revenue is a liability. Why is that? I have somebody's money that doesn't belong to me. So they gave me the money, I put it into my bank account, but I owe them the service that they paid for, or I owe them their money back. Okay? So unearned revenues is a liability, a debt. Does that make sense? Okay, and then owner's equity. Of course, initially, owner's equity is going to come from the pocket of the owner. Okay, so if I'm a sole proprietorship, somebody know what a sole proprietorship is? Sole meaning it's not this kind of soul, right? One, sole proprietor or owner, one owner. So sole proprietorship, United States, all we have to do is hang out a shingle, bam, you're a business, right? So sole proprietorship, one owner. So it doesn't take any kind of legal paperwork or anything to set up a sole proprietorship. Bam, you're just I mean, every one of you could be a sole proprietor if you want, and you may be. Okay, if I go in business with a partner, if I want to share the responsibility, the work, and the financing with a partner, I might start a partnership. So that's two or more people going into business and owning a company. So again, don't have to have any kind of special paperwork to start a partnership. We can shake hands and suddenly we're in business. Partnership. Then we get into other types of entities that do take some paperwork, and they are separate legal entities. So we have a corporation. Corporation is a separate legal entity. It can own land, it can buy and sell, it can sue, and it can be sued. Corporation. Okay, it has a birth certificate and it has a death certificate, just like a human. Okay, it may have a finite life, it may have an infinite life. Okay, corporation, and that's when we need lots and lots of people going together because we need lots of money. So you see where sometimes small businesses, maybe they used to be a sole proprietorship or a partnership, and they do an IPO. Who can tell me what that stands for? Initial public offering. So that's the first time that a non-incorporated business becomes a corporation. First time we issue stock. Initial public offering. We offer stock to the public so that we're soliciting other owners into our business. Why? We don't want their expertise necessarily, right? We want their money. Okay. Okay, so corporation. Another one that's relatively new is an LLC. Who can tell me what that stands for? Close. Limited liability company. Limited liability company. And so it's a little bit easier to deal with than a corporation. You can actually be a sole proprietor and be an LLC, or you can be a partner and be an LLC. The difference between these is that these entities have unlimited liability, which means that if you sue a sole proprietorship or a partnership, all of the owner's assets are at risk personally. It's unlimited liability. So if the sole proprietorship gets sued and it doesn't have enough money to pay for the settlement that has been granted to the person that's been offended, then the sole proprietor's assets are at risk. Same thing with a partnership. You go into business with a partner, this partnership gets sued, it doesn't have enough assets to pay for the settlement, whatever the judge or the jury decided to give to the injured party, then the partner's assets are at risk. The great thing about a corporation and a limited liability company is what? Limited liability. The only thing you can lose is what is inside of the company. It's what you've invested in the company. So if the corporation doesn't have enough assets to pay off the settlement, then that's it. There's nothing else that the injured party can receive. Same thing with the limited liability company. You cannot go through the company and go after the owners. That's why it's called limited liability. You can only lose what you have invested in the company. Make sense? Okay. So whichever form we choose, it's all going to be capital when we contribute that money into the entity. So whether we're selling stock to individuals because we're a corporation, or we're selling shares because we're a partnership, sole proprietorship, or an LLC. Okay? So then after a company has been in business for a while, they start to earn money, hopefully, right? Of course, we may incur losses, but if we do, we can't stay in business for very long, right? Oftentimes, the company may incur losses in the beginning, but eventually they have to earn a profit, or otherwise they're going out. So when a company earns money, that's called retained earnings. Retained earnings are everything that the company has earned from the beginning of its life until now that has not been paid out as a dividend. And I can explain why that name, and that will help you to remember it. So earnings, everything that the company earned is called revenue. Whenever we earn money, it's called revenue. So whether I'm Walmart and I'm selling crap that I bought from China, or if I am a CPA and I'm selling services, everything that you earn in your business is called revenue. Everything that it costs you to earn that money is called what? Expenses. Expenses. That's the cost of earning that money. So whether I'm Walmart and I have to pay China for all the stuff that I bought, or if I had to pay my employees, my utility bill, my computer bill, my supplies, so on and so forth, whatever it costs me to earn that money is called an expense. The difference between the two is called a what? Net profit, or if the expenses exceeds the revenue, it's called a what? A net loss. Okay, so we hopefully it's profit eventually. Okay, so revenues minus expenses. So that's our earnings. Revenues minus expenses. That's our net profit or net loss. Once we've earned a profit, those people that gave us that money, the capital, they want a return on that money, right? We call that a dividend. So money that the company has earned, and they're now going to pay that out to the owner for the use of their money, is called a dividend. So that's why the difference between those is called retained earnings. This is everything that we've earned minus what we paid out. What's left are retained or kept earnings. Does that make sense? Retained earnings. Hopefully that will help you to remember the term. Okay, so that's the accounting equation, the basis of our financial statements. Any questions about accounting equation? Okay. So the next step, I'm going to talk about how we track revenue. Let's pretend that we have a company. We want to know how much money we've earned. So we do financial statements. The first financial statement that we do is called an income statement. We're going to put revenues and expenses. Remember the trucking company? We did one trip. We earned $4,000. That was our revenue. Well, let's pretend. Let's say that we're a CPA firm. We've earned $100,000 in accounting fees. We have some staff. We have to pay them, right? That's an expense. Wages expense. And usually you list your expenses, the largest one first. So if I'm Walmart, what's going to be my largest expense? China, right? All that stuff that I bought to put on the shelf. Okay, so cost of goods sold will be my largest expense if I'm selling stuff. But if I'm a service business, probably wages. Okay, so wages expense, that's paying all the employees. What else? I got to pay utilities, right? Actually, I may have to pay rent. Of course, I own my building, so I don't have to pay rent. But some companies would have to pay rent if you didn't buy the building. All right, so let's say rent was, let's say it was $1,000 a month, so $12,000. Let's say utilities was, no, we better pay more than that for utilities. It's kind of cold. Okay, utilities expense, rent expense. That makes sense. What else? Supplies. Quite a bit of supplies. Let's see what else. If we had to borrow any money, what do you have to pay to the bank when you borrow money? If you go sign a note at the bank, interest, you have to pay some interest. Okay. Did he say something other than? I have a hard time hearing when I have this plug in my ear. Okay, so if I had debt, I would have interest expense. Um, what else? I might have some property tax expense. Wouldn't be much because it's just going to be on my equipment if I don't own a building. My equipment depreciates. Does anybody remember the term depreciation expense? It's depreciation expense. What does it mean to depreciate? Goes down in value. Okay, so all of my fixed assets, assets I'm using in my business, what's the fixed asset? They're permanent, which means they're going to last more than a year. They're tangible, which means I can touch them, so tangible, and they're being used in the business. That's a fixed asset. So things like land, buildings, equipment, those are fixed assets. Now we don't say inventory, even though inventory is tangible, because it's available for sale. We're not using it, so it's laying on the shelf. It's not being used up. So we depreciate fixed assets, but of course we don't depreciate inventory because we're not using it. We're not wearing it out. We're trying to protect it so that we can sell it, right? Okay, and of course accounts receivable is not tangible, so you can't wear it out. Okay, does that make sense? So when fixed assets get used up, it becomes depreciation expense. Depreciation expense, the using up of fixed asset. Remember the truck? What was it? We paid $100,000 for the truck. And whenever in accounting and in business, whenever we buy a fixed asset, we estimate how long it's going to be of value to us because we need to know that, right? If I'm going to give $100,000 for a truck, I certainly need to know about how long it's going to be of value to me. Otherwise, how would I make the decision to spend $100,000 for that truck? Okay, so if it's only going to last a year, that'd be kind of stupid, right? But if it's going to last for 5 or 10 years, or I've seen some big rigs on the road for 30, 40 years, some of those good old Macs. But we, in our example, we estimated that tractor, that truck, was going to last for 5 years, and that's a pretty good estimate. Actually, the IRS lets you write it off over 3 years because some of them they run the wheels off of them really quickly. So if we estimate that truck's going to be a value to us for 5 years, then we're going to depreciate it at $20,000 a year. Okay, so we never know exactly how much a fixed asset got used up during the year, right? In order to do that, we'd have to appraise the value of it at the beginning of the year and the end of every year. That'd be kind of a waste of money. So what we do is we estimate. Accounting is not an exact science. Some things are based on estimates. So we estimate how long a computer in my office, we estimate how long it's going to last. And we depreciate it over the estimated useful life. So 5 years is the estimated useful life. So we're going to depreciate it $20,000 a year. So depreciation is not an exact number. It's an estimate of how much the fixed assets got used up during the year. Okay? All right, let's see. So let's say that's it. So we throw some miscellaneous expense. That's where we just throw everything else. So whatever that total comes to, $8,000. How much did I earn? $62,000 profit. Did that in my head. I may be wrong, but that's okay. Okay, so there's an income statement. What does that tell us? That we made money, right? We earned some money. Who wants to know this about our business? The owners. So if we solicited other owners, if we borrowed money from the bank or a finance company, they're going to want to know how we're doing, right? Otherwise, they're going to send the take back man if we're not going to make some money because they want to get theirs first. okay, before we use it up. Okay, so everybody that's interested in our business wants to see an income statement to see how well we're doing. Let me explain to you how an income statement works. Revenues on the income statement is everything that we earned during the period, whether we collected it or not. Does that make sense? Otherwise, it wouldn't make sense. So, for example, if I'm an accountant and I finished a large job um, that was maybe it was a $10,000 job, I've done them, and I finished it during the month, but I didn't get paid that month. And maybe that was the only job that I did that month. I had no other revenue other than the job that I completed, but I didn't get paid that month. My revenue would be zero if I was only recording the revenue that I received. So that's why revenue has to be recorded as it's earned in order for this to make sense. Okay, so revenue is recorded as it's earned, whether it was received or not. Otherwise, I could manipulate the numbers, right? I could ask a client to pay me earlier if I wanted to show a profit, or if I wanted to show a loss for some reason this month because I was maybe trying to get some help from somebody that I'm pulling on their sympathy and I wanted to show a loss. Don't pay me yet. Okay, so I could control that. So in accounting, we have rules that say revenue gets recorded as it is earned. So we don't get to manipulate the numbers. Okay. All right. Expenses are recorded in the period with the revenue, whether we paid them or not. So if the employees haven't been paid yet, we still put it on there as wage expense. And then we also put it over here as wages payable. Okay. So all of it's an expense, whether it's been paid or not. The portion that hasn't been paid yet ends up over there on the balance sheet. And when we looked at the balance sheet, it showed all the assets, liabilities, and owner's equity. So the wages that I haven't paid yet are on the balance sheet. This is all the wages that I incurred for the whole month. Same thing for utilities. This is all the utilities that I incurred that helped me to earn that $100,000. If I didn't pay any of them, it's over there on the balance sheet as a liability. Okay, does that make sense? Rent, if I didn't pay all the rent, part of it's over there. So this is everything that I have incurred this month so that I get a true picture of how much money I earned or lost during the period. Make sense? That's what makes the income statement valuable. All right. Then let's look at what a balance sheet looks like. Actually, the second step was to do a statement of retained earnings. I'm doing on time. What time does class end today? 11:30. Oh, I'm almost done, aren't I? Okay, that's fine. We're going to do this again and again. Okay, and you're going to do some of these. So what I want you to do is this is the accounting equation. I want you to teach that to me. Okay, so now I'm recording this, so you can watch this video again. I want you to explain the accounting equation. Give me examples, and do it on video if you want, or you can type it out. I've had students that actually record themselves teaching the accounting equation. I think that's kind of cool. Or you can just type it out and you can just tell me what it means. But the gist of it is I want you to understand that a business has to have assets, and there's two ways to finance them, either through borrowed money or through equity. So debt or equity. Equity is when we have owners. Okay? Let me explain to you real quickly, and we'll get more into this when we talk about financial statement analysis, when we start analyzing companies and deciding if they're in a good way or a bad way. The difference between debt and equity, debt has more risk to it. Because if I go to the bank and sign a note, what does that note say? I'm going to pay that money back plus interest, right? And if I didn't, then the take back man's going to come, right? Okay, so I'm going to be sued for the balance. So they're going to come and get, if I used equipment or a building or a vehicle, whatever, for the collateral. Remember that collateral for the loan? If I have collateral, then they're going to come and get that collateral. and they're going to sue me for the balance. So there's risk to financing with debt. I have to pay it back at a certain time. Financing with equity, owners are not going to cause you to be shut down, right? The owners know that you're a new company, that you're just getting started out, so they're going to be more patient with you until you can start earning a profit. At some point in time, they're going to get tired of the venture, right? And they're going to want some payback. But generally, owners are more patient because they understand when they invested in your company that you're a brand new company. So usually, new companies start financing with equity, not with debt. Besides that, banks are averse to risk. They don't like risk. The FDIC likes to audit them on a regular basis and see if they're making bad loans. Why? They have citizens' monies that they're loaning out and the U.S. government's monies that they're loaning out, or I should say the Federal Reserve, which is not really a part of the U.S. government, but most people think that it is. So therefore, banks are less likely to loan money to a startup because you have no history. So unless you have an owner, so for example, I had a history before I ever started a business. So they knew that I would pay back the money. I could call up my banker and say, I need 100 grand. Can you put that in my account? And he would do that because I'd paid him more than 100 grand before. Okay. So if you have that kind of a credit rating, then maybe you can borrow money when you start a business, but not everybody does that. All right. So a brand new company, and you need a lot more than 100 grand sometimes to finance a new company. So you may need to solicit owners rather than borrowing from the bank. Does that make sense? Because banks are going to be less likely to loan to a new startup. Okay? All right. That's all I got to say about that. Everybody get my sheet signed, please. And so pay attention to you learn. That's where all your grades are going to be. Grade book has got everything in it so you can keep up with how you're doing. Thank you, sir. Everybody sign this, please. And I will have a problem for us to start working on next class.